This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
We've got another Postgame chart book this week. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Look for the red button that says Looking for the Downloads, right above Daniel Lacaille's picture. Patrick, first chart here, S&P 500. What's going on?
So, Eric, what I wanted to talk about here is just something you already referenced earlier, which was the fact that we're at such critical moments on so many of these different markets. And rather than trying to play the game of forecasting, it's important to highlight where these levels are and what we have to watch for next week in terms of some of these major breaks. And so the name of the whole chart book is called Holding the Line. And what I wanted to start talking about first was just what's happening with the S&P 500. Now, first of all, what we had was a period that in the post-election window, and then especially after all the vaccine news started coming out, all of this pent-up money that was on the sidelines and all the hedging that was going on and all the extra volatility that was being priced in the market, everything just kind of normalized, and that allowed the S&P 500 to have this just surge higher up towards the 3,600 level. And what we now find ourselves is that we're going into the November option expiration, and we are right pinned to the 3,600 zone, which is where there's like the golf ball in the garden hose in the structure of the options. And so it's very likely it's going to be sticky going into Friday's close. And so just using some of Charlie McElligot's numbers, like the S&P's to the 97th percentile on Delta dollars with 30% of the gamma set to roll off this weekend. The QQQ has 50% of its gamma rolling off. IWM, which is the small caps, 39%, and even the emerging markets, 36%. So there's this unpinning going to happen after the weekend. And so it's amazing that we're seeing all of these markets all wound up at these critical moments. And then we're going into this option expiration where we're about to roll off. I asked the question, are we about to see some volatility return back to the market starting on Monday? And that's what we're watching for sure. And so on S&P chart on page 3, I just have the 3,600 line drawn out there. The interesting part will be is that will we just get a very natural retracement of this post-election surge we had? What's interesting is that even a natural Fibonacci retracement would be towards 3,400, which most traders will find it very hard to stomach a 150 to 200 S&P point pullback. That would not even be the beginning of a correction. That would just be the market backfilling some of the election pop. And it'll be really interesting to see whether that comes in early next week on that. And so what the other thing I wanted to highlight was on page 4, which is the volatility. And one of the things that we saw contributing to the market upside was the huge contraction of volatility. There was this big volatility premium, a lot of money on the sideline, and then we saw that backing right off. And we're back down to the pretty much the 2020 lows in the post-coronavirus period. And one of the interesting things is that we have this major support line of volatility, yet the average volatility prior to the coronavirus was all the way down, always in the low teens. And one of the interesting things that I think we can watch is whether or not volatility here finds the lows along this new higher level, or whether or not we're going to still continue to see lower volatility levels.
Patrick, let's move on to the dollar index on page 5. Seems like we're holding really right around that 92 handle as the bottom of the trading range. What do you see next here?
This is the same theme, which is we're at a critical support. And the price action has been incredibly weak, incredibly distributive, but it is a very crowded trade to be bearish the dollar. And so there's obviously room if the support holds for it to go squeezing higher. But at this stage, there's almost no price action supporting a US dollar rally. It's so very weak. And what would be interesting is that if this level gave out, the next major support is all the way down at the 89.90 level, going back to 2018. That would certainly be a tailwind for the euro. And so watching into next week whether or not the dollar can hold this support line is going to be high on the watch list in terms of things to keep an eye on.
It's fascinating that the dollar and gold are both at the bottom of their ranges. Normally, the dollar and gold, at least most of the time, trade inversely to one another, but they're both testing the bottom of their ranges. Since we can see, starting on page 6, that the other currencies are at the top of their ranges, the dollar index is the one that's making sense. The gold is the odd man out there. What do you make of that?
We could talk about gold when we get to that chart, but you can see where the US dollar weakness is coming from. The euro, obviously being the largest trade-weighted component of the dollar index, is the predominant driver of that dollar index. And so that euro continues to gravitate to the top end of that range. And it'll be really interesting. It'll be very hard for the dollar index to break down without the euro correspondingly leading the way, surging higher. And so this is going to be, I think, the most important of the currency pairs to watch to see what's happening. But what's really interesting is that whether it's the euro, whether it's the Aussie dollar on page 7, or even the Canadian dollar that's not on here, those two commodity-based currencies or influenced currencies by commodities are gravitating again to the top end of the ranges. It's like everything in this macro space is coming to an important crossroad. And it feels like next week will be potentially a really big week for determining whether or not these are going to be big breakouts. And that's for sure what we're going to watch.
Yeah, and we see it here on page 8 with crude oil. And the way I assess this is, even though you would think that the long-dated crude oil futures would be up and the short-dated ones would be down, the market never works that way. If the market is looking ahead toward there being relief to the crisis next year, what people are buying is the front month contract. And I think that's what's holding us at the top of this range. It'll be very interesting to see if we break out of it. I think we ought to go test the bottom of the range first as we get through the next few months of difficulty. And I definitely think much, much higher crude oil prices are in store for us by the end of 2021. By 1 year from now, I will be shocked if we don't have considerably higher crude prices than we have now. But in the meantime, I think there's plenty of room for a significant move lower first.
One of the things that I'm going to be watching is whether or not everything stays in line from a natural intermarket correlation. Certainly, if the dollar was to start breaking down with some sort of velocity, that would act as a tailwind to a crude oil breakout. And so it'll be really interesting to see whether or not crude oil kind of follows that script, or whether it can kind of march to the beat of its own drum. One way or another, what's interesting is those energy stocks that we talked about last week continue to be accumulated very well. So at least there's some conviction out there that there's been a turning point of some sort, at least enough to accumulate those energy stocks. So it'll be interesting to see whether oil goes along with that story. And so now on page 9, I want to move on to gold.
Now can we talk about gold now that we're on that chart?
Yes, there we go. We can talk about gold now. But you were bang on. It's really interesting to the fact that gold has been so weak, but it's been almost perfectly correlated to the weakness of the dollar. And obviously, we've had no shortage of MacroVoice guests that come on and talked about, obviously, gold's correlation with real yields, which has been what's been pressuring gold to one degree or another here. But it's certainly also interesting, and we don't have a chart to speak to it, but really, gold was, for the longest time, also viewed as a safe haven asset to in the same category as Bitcoin, but Bitcoin has been just screaming higher in a full-on bull market parabolic rise, and gold has just been left behind. And it's really something that a lot of people in the FinTwit world have been highlighting, and it certainly will be interesting to see whether this trend continues or whether gold is just late to the party and that the reversal will inevitably come. So finally, I want to touch on the chart on page 10, which is the Bloomberg Commodity Index. And it's interesting that it has many of the same characteristics that those cross currencies have and crude oil has. It's like bouncing its head up along the top end of resistance. A lot of the different commodities are doing very well, particularly the grains and even coffee's had a really good run recently. And so you're seeing a lot of commodities doing very well, including copper having broken to a higher high. And yet this commodity index is sort of just crawling along that upper boundary. And my call on all of this is that either it's all going to break out or none of it's going to break out. I think that it's the single most important thing to keep an eye out for next week is that are we going to see everything just get charged with all sorts of new momentum and some of these big breakouts really start to follow through. And that's for sure what's on my watch list.
Well, Patrick, I agree with that sentiment that this could go either way, and it's going to be really interesting to see what happens because in a lot of these cases, I see it as time frames. On one hand, like let's take copper. On one hand, copper is traditionally a kind of a barometer for the economic condition. If we're going to have an economic downturn because of this massive increase in cases and hospitalizations and deaths in the COVID-19 crisis, copper is probably going to take a hit here. But you know that if the Biden presidency is going to happen, which it appears that it's almost certain to, you know a major theme of a Biden presidency is going to be green energy. There's probably going to be a combination of emphasis on electric vehicles, which you need copper to build, and also a build-out of a new electric grid, a new distribution grid for the United States, because there's no possible way that the current one can recharge a meaningful increase in the number of electric vehicles that we already have. So there's a huge copper demand, and you've got prices of copper generally moving up in an inflationary environment, which is going to be created by all of the money printing that's coming. So you know copper's got to be headed much higher, very much the same story as oil. It's just, does it have a leg down first? That's the part I can't decide about. What I do know is that our listeners can get a 14-day free trial of Big Picture Trading. Find the details on page 11.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.